Good morning, everybody. This is Esther Cañada from the EU SME Centre, and today we are going to talk about one of the ABCs for European SMEs wanting to go to China and do business in China. We are going to talk about setting up a business in China. But before getting into the topic, let me say a few words about the center and also about our speaker. So the EU SME Centre is a project funded by the European Union and implemented by 6 partners that are based in Europe and in China. Our goal is to help European SMEs enter and operate in the Chinese market. We do that through providing a variety of services such as trainings, seminars, reports, advocacy activities, free consultations, and of course webinars like this one. We have a network of over 270 government agencies and business support organizations, both in Europe and China. And we have experts and employees both in Beijing and in Brussels. Finally, we have in-house experts on the key areas of market access, business development, legal, HR, and standards on conformity. Now, about our speaker. Russell Brown is founder and managing partner of Lehman Brown International Accountants. Lehman Brown is a China-focused accounting, taxation, and business advisory firm with operations in Beijing, Hong Kong, and 5 other offices across China. Russell is advisor to international companies entering the China market and also to Chinese companies that want to go abroad. And he has experience in a wide range of industries and business situations, both in China and in Hong Kong. Russell is a fellow of the Chartered Institute of Management Accountants in the UK and a fellow of the Institute of Chartered Accountants of England and Wales. And finally, he's also a certified global management accountant. And without further ado, I give the floor to you, Russell.
Thank you. Well, today what I want to cover is really all the considerations and the do's and don'ts and things that you need to worry about when coming into China, in the hope that with knowledge, the fear factor and the risk factors of coming to China can actually be taken into account in a business plan to make China a success story when companies come here. The first mistake often that companies make is actually not understanding the size of China and the fact that it's actually multiple markets. It's almost like the United Provinces of China. And so the key question is, where is my market? It's not about looking at the sheer volume of example population, but it's finding where can I get a foothold, and with that foothold build a base, and from that base grow. And I think that's the key question. Some companies say, oh, I must be in Beijing or I must be in Shanghai, but you're going into high-cost cities, for instance, where if you go into some of the more regional cities, there's a much lower cost of doing business and therefore cost of entry. So the first question is, where is my market? Where can I get a foothold and build a base? And then in the business plan, there's looking at business risk. Now, we split business risk down into 6 key areas. Some have more weight according to whatever your business model may or may not be than others. But I think it's important to look at these risks. So, for instance, if you are going to be selling products or manufacturing and making products for sale in the market, what is your market risk relative to your competitors? How innovative are they? What is their price setting? What extra value do you add with your product? Human risk, which is anywhere in the world, but how do you deal with that? And I will have a slide later on to talk about human resources, but it's about doing proper checking of people, doing reference checks, and doing all of the things that you should be doing, but often people don't necessarily do because they get told, oh, this is China. Well, China actually now is actually quite a functional and developed country in terms of its legislative situation, and they have a strong labour law, and it's a matter of applying that properly in the documentation. Economic risk, of course, China's economy keeps evolving. We have things like the current US trade spat, but China continues to evolve and grow. So economic risk is more about changes in government policy, though in recent times these have been positive, with opening up of markets that were previously restricted, providing incentives for certain industries. So the economic risk has actually been more the benefit, but there can be markets that open up or close down.
I think that perhaps one of the risks, or rather the issues that companies should look at when it comes to China that may differ from other markets, such as neighborhood markets or US markets, is to look at the industries that are, again, restricted or prohibited, because I think that's quite quite specific to China, I would say.
That's right, market access, that's right. Our market access, or rather restrictions to market access, is something that continually evolves. And whilst generally opening up, there are sometimes industries where the government sees certain levels of saturation and they may decide to restrict those industries more. We then have management risk, which is really about making sure that you have the right competent managers, that you know their history and backgrounds. If they're hiring people, you've also, on your behalf, that you've also done some checking. Business risk, I actually should have this in flashing lights, because by far the biggest issues that companies have with regards to fraud or things going wrong is lack of internal controls and segregation of duties. Whether it be from bank accounts to choosing of suppliers to logistics. How do you reduce the risk by making sure you've got proper business processes, or 3PC as I call it, policies, processes, procedures and controls in place?
Are there any specificities to the Chinese market in terms of these business risks, or would you say that these are present anywhere companies go?
I would say they're present anywhere, actually. It's just sometimes we always joke a little bit and say that when people come here, they leave their MBA brains at home. I think here the legal system is maybe not, it is developing and it is much better than it used to be. But if you can actually put in place proper controls at the beginning, you're reducing the risks and therefore the need to take up legal counsel in the first place. Mm-hmm. And then lastly, legal risk. There is a lot of checking that companies can do now. So you can go and get a credit report, for instance, on Chinese companies. You can find out the directors, the owners, whether they've got any legal cases against them, what their scope of business is, what their registered capital is. You can check on ownership of intellectual property. You can check on land and building licenses. So there's a lot of background checking that can be done relatively inexpensively on companies you want to do business with or people you want to do business with.
I believe that you're going to talk a bit about it later, but I would personally like to point out two IP-related risks, as it has been an issue that has plagued foreign businesses, especially European businesses, for quite some time. And even though China has been taking steps to improve it, it definitely remains a concern.
Yeah, I would absolutely agree with that. In fact, I think my next slide actually is on IP. I mean, the first question, when somebody comes to me and says, I want to go to China, before I even talk about the structures, before I even talk about tax or anything else, the first question I always ask them is, have they registered their intellectual property? Particularly their trademark for their brands, company name or brand names of products or services. And whilst the system is now much improved and we do have specialist intellectual property courts, and the current trademark law does talk about, for example, malicious filings. The reality is it is still a first-to-file system, and so you want to make sure that you filed before one of your future working colleagues or partners might file on your behalf, and then you have a long legal case to recover. And so patents as well could be looked at. I mean, patents are more complicated. Depending on your situation, it could be worth considering, and likewise copyright as well. But I would say definitely trademark as a number one before even bringing a product here, even if you're not going to set up here.
I would say that, again, this remains a big problem, but in terms of looking at the burden, especially the cost for SMEs in China, there have been a couple of positive developments. There has been the establishment of the IP courts, but also recently the establishment of internet courts. And I believe that some months ago, it was decided that blockchain could be used as evidence, which would definitely reduce the cost, the burden of proof.
Yes,
I would say for companies. But again, as you say, you have to be prepared and you have to do your homework.
Yes. The cost of filing a trademark is actually very inexpensive. It's just a matter of making sure you've got the right categories covered. Mm-hmm. Patents is a different ball game, and that could be as small or large depending on the complexities. So where to set up? So and whether you can set up. So China now has something called a negative list. We used to call it the category of industries. And the negative list is continually being updated. In fact, the most recent update was announced last week. And this says what you can and can't do. So as a foreign business. So it says, for instance, whether it's an open industry, whether it's partly restricted, which means you may have to do a joint venture only, whether it's prohibited, which means you cannot establish in that particular industry. And then different zones have their own negative lists. So, for instance, Shanghai Free Trade Zone, Shenzhen, or Greater Bay Area now, and Pearl Delta, they have their own negative lists where there may be things that you can do in that particular zone, but you can't do outside of the zone in the rest of the country. And these are continually changing. So normally when we get asked a question, can I do something? If it's on the restricted list on the national level, we will then look at the zones to see if it might be possible in one of the zones to do what the company wants to do.
Yeah, actually I believe that the latest list came out a couple of days ago.
Yes.
So definitely, I mean, every year things keep changing and you have to, be constantly on the
lookout.
On the lookout,
That's right.
Yes.
I mean, generally, I would say this is positive. I mean, there is one negative which I'll throw in. Sometimes you have an industry that's taken off the negative list, but all that means is that the decision making is moved down to a sub-department, and the sub-department will have their own list of criteria, which may hinder, example, because there's a special license required, foreign investment in that particular area. And so in the new ball game, let's call it, it's a matter of checking whether there's any sub-departments that have certain criteria in industries that maybe have just been taken off the negative list.
Yes.
So this is just another slide that shows prohibited, restricted, encouraged, which is tax concessions, and I call it conventional, which is no restrictions but no concessions. Now, prohibited, it doesn't necessarily mean that you can't do something, it's just a matter of how you do it. So whilst there may be, taking publishing for instance, there may be a need that the local company has the publishing license, but the foreign partner may produce the content, organise the advertising, arrange the design. So there's ways of cooperation between a Chinese company that has the licenses and a foreign company that has technological know-how in that area.
Like a variable interest entity, for instance?
Well, variable interest entity is possible. That's where you have, in effect, control over a Chinese entity. But actually, it could be more partnering with a Chinese company where they do part of what is required that comes under the license, but the part that doesn't come under the license can be done by the wholly foreign-owned company. So there's ways of still working around. I mean, on this slide, actually, I've still got oil and gas field ownership, but I know there's, in the recent negative list, there's been some changes in the oil and gas industry, for instance. In terms of legal entities, the main ones that are established are what we call a wholly foreign-owned enterprise, a WFOE, which is services or production, or foreign invested commercial enterprise, which is trading, retail, distribution. They're limited liability companies. They operate exactly as a limited liability company would in most jurisdictions in the world, where it has investment from the shareholders, and if the company gets into financial difficulties, it can fall into insolvency or bankruptcy, and there's shareholder protection. There is something called China Holding Company, which is not really popular these days. So basically, WFOE and FIEs are the main two that companies will set up. You can also still have joint ventures, of which there's a contractual or cooperative joint venture, which has flexibility in terms of what you can include within a joint venture contract, and the joint venture contract sits alongside an Articles of Association, and so they hold equal weight, or an equity joint venture which is governed by an Articles of Association in the same way as a WFOE or a FIEs.
And I guess that for each business, the circumstances and the situation is different. But if you take into account rather small enterprises which have limitations in terms of resources, would you have any specific recommendation when it comes to considering what type of entity to establish in China?
So the first key question on which type of entity is what do you want to do? So what is your scope of business? So if the aim of the entity is purely to provide liaison, facilitation and support services, for instance, which could be to just liaise with channel sales distributors within China, or to liaise with suppliers of product which is to be shipped out of China, then actually a representative office, which is a branch, would suffice. Because in this situation, there's no income going to be generated from this entity. It's purely a cost centre. And all the sales are direct to either B2B or B2C, but they're direct. If you anticipate that you're going to have actual income, then you need a limited company. And then it's a matter of just the nature of FIEs or WFOE. They're actually identical. It's just down to the scope of business. And so the question is, will you be operating and trading in terms of receiving income for services or receiving income for product sales? And if the answer is yes, you need a limited company. If the answer is no, and it's purely liaison support, then a representative office or branch is sufficient.
Any comments on the joint venture?
And a joint venture only makes sense if both parties, if there's strength in numbers. So, but if a joint venture partner has value that they're bringing to the table, which will benefit the foreign party in a business relationship, then it's worth considering. It is more complex, of course, because you have, by nature, another party. You will have, therefore, multiple shareholders and multiple directors. You need to think about all the decision-making matrix of who and what decisions each party will make. And it's, as we say, easy to get married, but not so easy to get divorced.
Right.
So most companies, unless there's a business need for a partner, or it makes sense to have a partner, will go with a limited company, WFOE or FIEs, or a branch. which is a liaison support company. So after working out what can you do, what you want to do, what kind of legal entity, then the next is registered capital, how much to invest, and whether you want an investment loan. And there are thin capitalisation rules on this, and I've got a slide later on that. But just a note on the registered capital. Under the company law, the registered capital is as decided by the shareholders and the directors as being sufficient for the company to be liquid. And so there's no need. In the old days, we used to have minimums for different kinds of industries.
Right.
This still does exist for certain industries, but not for most. The majority now of companies can choose what their registered capital or their investment is. They can also choose on the timing as well. So there used to be a limitation on the time when you had to bring in your capital. Now you can choose what the amount is. You don't need to be held to that amount, and you can choose the timing.
As you know, access to financing is a big issue for European SMEs, at least those in China. So in terms of bringing in capital, would you recommend trying to find investors or trying to raise the capital back home for a foreign company, or trying to get Chinese?
If I go on to point to, I suppose, invest holding structure. If you're looking to bring in Chinese investors, then by nature you're creating a joint venture relationship within China, where if you can have external investors coming in at a holding vehicle level offshore, your Chinese entity is still a 100% owned limited liability company. But your offshore vehicle, in whichever jurisdiction makes sense for you as an organisation, would be where you would have those investors coming in. But if your investors are going to be within China, then it's a matter of how you structure the Articles of Association so that you can have investors coming in, but you don't limit your control over the business.
I see.
And one of the questions often asked about direct versus having an offshore, so do you, for example, invest from Germany direct into China, or do you go via Hong Kong or Singapore or somewhere else? There used to be a tax question for China, but actually China now has quite robust regulations on withholding taxes. It does have a lot of tax treaties, but to take the benefit of the tax treaty, you need to have substance in that location. So a pure holding vehicle wouldn't be able to take treaty benefits. And so when looking at direct versus having a holding vehicle, the main reason for having a holding vehicle would be if you're going into a joint venture, it allows you to sell out at that holding vehicle level, or as we just mentioned, if you're going to have other investors coming in, you could bring them in at that holding vehicle level. From a tax perspective, though, you need to look at the whole chain of tax from China all the way through to head office to see whether it makes sense to have a holding vehicle or not.
Right.
And adding that extra layer of bureaucracy as well. We talked earlier about where is my market, but another consideration are the zones, and there's zones all over China, different free trade zones, high-tech zones, processing zones, logistic parks, go west, go central. So we would look at the zones to see if there's anything specifically on offer, if a company has flexibility in where they may want to register or be based. I would say the easiest place at the moment to set up in China is the Shanghai Free Trade Zone. Okay. Easiest, quickest, less bureaucratic, compared with the rest of the country. There's probably the second would be the Shenzhen greater area.
For any type of sectors or industries?
Any kind of legal entity.
It's okay.
They've streamlined a lot of the process, and so even though I think they mark it 5 days to set up, in reality it's never 5 days because it takes you a few weeks to get your documentation together in the first place.
Yeah,
and then you're normally a little bit of back and forth with the government officers, but you're still significantly faster, and you're talking a month or so, maybe 2 months maximum.
Actually, I believe that the government has set 5 days, 5 working days for registration nationwide recently. But I guess we will talk later about.
They have done that, yes. Unfortunately, example in Beijing, Chaoyang district don't seem to have read that yet.
Right.
But Shanghai, I will say, is the most progressive, and I would say Shenzhen, and I also see the Greater Bay Area being very progressive as well.
Of course, there has been quite a push.
Yes.
In that area.
And then lastly, business model selection. How are you going to receive funds? How do you pay out funds? Looking at licenses, transfer pricing. And I will talk a little bit about tax in a second, but it is a matter of looking at your overall tax structure and what makes sense from a, not just a China, but a group perspective.
Right.
There are other ways of coming in initially, more nimbly. So this might not be setting up. It might be cooperating with a Chinese company that manufactures for you under contract, or in the service industry arranging a cooperation agreement with a local company. Cooperation agreement, a good example might be design and architectural firms who may be doing the designs overseas, but they partner with a Chinese design institute who does all the registration of the plans. Possibly the local design institute even hires people underneath them on behalf of the overseas entity, and they have a cooperation arrangement during that project.
So basically that would be a way of trying out, or rather getting your feet wet. Getting your feet wet,
doing some business here, and servicing your clients in the service industry or in manufacturing, being able to get the quality checks and get the level of product quality up.
And seeing how it works. Correct,
and seeing how it works and testing the market or testing the supply chain. We talked about locations, but if I talk about tax incentives, just like the negative list, tax incentives can be location specific, so different zones or different areas can offer tax incentives to different industries, and they can also be country or nationwide with regards to specific industries as well. There are lots of different things that are being offered around the country, whether they be specific tax reductions. Example, if you're a high-tech business and you can get a 15% tax rate, or whether they are linked with, example, government grants for investment, linked with investment and hiring so many heads in certain industries. And these are continually evolving. So I won't go into detail in this presentation today because there's too many different specifics, but I think the key message across is when coming in to look at, is there anything location specific, is there anything industry specific?
Okay.
And when doing tax planning, I like to use the word total tax cost. And total tax cost is the net total tax paid, not just within China, but within a group. Because if you're a privately held business where individuals own an overseas company, which may own a holding vehicle or may not, or company offshore, which then owns China, you have to flow the taxes from base all the way through until eventually the funds get into the shareholders' hands. Right. And what is the total cost of that total flow through? So we can tax plan in China, but if you save tax in China but pay tax somewhere else, it doesn't necessarily benefit the organisation. So it is a matter of looking at the total tax structure. From a China angle, though, the taxes that we would look at, the main taxes would be value-added tax and customs duty on imported goods,
right.
Value-added tax and value-added tax rebate on exported goods, VAT and surcharges on passive income or services, withheld corporate income tax, where there may be a permanent establishment created where you may have people in China with no legal vehicle, but it's being treated as if you did have a legal vehicle. Withholding taxes on any royalties being cross-charged. Would look at tax incentives on a zone or national level, and possibly individual income tax planning if it's an owner business and a closely held business. then that individual needs to look at what taxes they might pay in the company versus what tax they might pay as an individual.
And of course, we have to take into account the recent changes on individual income tax.
Correct.
In
And
China.
correct, and the 6-year rule, which allows no offshore tax, global tax for 6 years, and also things like the Pearl Delta, the Greater Bay Area, where the full implementation guidelines haven't come out yet, apart from I think one zone, Qinghai zone.
Mm-hmm.
But actually, the aim is if you're based in the Pearl Delta area and you're foreign, you could be treated as if you were taxed on Hong Kong level, which is a much lower tax rate.
Interesting.
And then dividends. Dividends can be distributed at any time, and they are subject to withholding tax. But if you're paying withholding tax, the key question is can I get that tax back under a tax treaty somewhere else?
Perhaps I would like to also mention that for SMEs in particular, in recent years, the Chinese government has been really pushing towards reducing the financial burden of SMEs through fiscal policy. And thus, we have seen in the past a lot of, I would say, preferential tax policies and tax cuts, specifically for SMEs or for micro SMEs.
No, that's correct. So one example of that would be if your annual profit is below 1 million RMB, you'd pay 5% tax on that. And then between 1 and 3 million RMB, you'd pay 10% tax, which is a much reduced rate.
Exactly.
So once you've decided where you want to establish, then there's various other things that need to be put in place in order to establish the business. So if, for instance, the decision was a representative office, one key criteria is that you need to have the parent of the representative office needs to be a year old. If it's a representative office or any other legal vehicle, you need a lease agreement, which is proper for the space usage. So, for instance, if you're going to be a commercial office, it needs to be a commercial space. If you're going to be manufacturing, you need an industrial space. Mm-hmm. And a minimum of 1 year lease contract. Normally, you have to have paid 3 months up front, 2 months deposit, 1 month's rent at least. And that particular space needs to be able to provide, or the landlord needs to be able to provide the respective documentation. Mm-hmm. And so we would normally check to make sure that that space is fit for purpose for the use. It's not possible to have, outside of the free trade zone in Shanghai, virtual offices in China, though there are service centres around China that can provide what is in effect a virtual office, but they'll rent one space, one desk to you. If you need a registered office without necessarily needing a formal office, then there are service centres that can do that around the country. Mm-hmm. There is some information that needs to go into the application, such as how many employees are going to be hired in the first year, sometimes a little bit on the proposed financials for the first 1 to 3 years. And then it's important to understand what your cost base may be, not just only because of the information required by the government, but it's also ascertaining the investment need. So how much money do you actually need until you become operational? Right. And that will define what your registered capital requirement may be. And who's going to be an investor? We talked about holding direct or indirect. There are documents that need to be prepared by the investor, which have to be notarized and consularized, which can take some time. Mm-hmm. The only place where you don't need consularization is Hong Kong, because in Hong Kong, the Chinese government has an agreement with Hong Kong whereby Chinese notaries based in Hong Kong can notarize those documents. Mm-hmm. And that's sufficient, where other countries you'd need to go to the consulate or embassy to get consularization.
Right.
Which bank will you use? And does the bank do your group bankers have banking arrangements here? Or if not, other banks can be found. And then who are the key persons going to be? And I'll talk about that in a minute, about who the key positions are. And this information gathering, the notarization, consularization, and finding a lease agreement, typically you need to allow at least a month or so, we normally say. So in terms of management, there are some named positions with the government, but titles but not named with the government. So government registered legal representative, which is the chairperson of the board or the number one position within the company and doesn't need to necessarily be a board director. The board of directors, and then the supervisor of the board. The supervisor cannot be the legal rep or the board of directors. In most jurisdictions, a lot of jurisdictions in the world, we have something called a corporate veil, where there's separation between shareholders and directors. China, that is blurred because China says that the shareholders will appoint a board of directors and the legal person on the one side for operations and decisions, but on the other side they'll also appoint a supervisor of the board or supervisory board of the board, which is also directly appointed by the shareholders, but whose purpose is to watch what the directors and the legal people do, the legal person does, and to feed back to the shareholders. So if the directors do something that's illegal, and the supervisor is aware of that and has submitted that information to the shareholders, and the shareholders have not taken action, then the corporate veil becomes blurred where the shareholders could become liable. So that is one difference in China between, example, the UK where I'm from, for instance, where there is a separation, or even Hong Kong in common law between the shareholder and the director.
I see.
You also would appoint a general manager. The general manager can be the legal rep or can be a board director. And the CFO or accountant, which is registered with the tax bureau. And the salary positions are can resign and the responsibility stops. But if you are appointed as the legal rep, or board director, or the supervisor, if you resign, the responsibility does not stop until the company has replaced you.
What about in terms of small businesses?
So a small business could have one person who is the general manager, the director, and the legal rep.
Okay, so these titles can be held by
Yes,
one
correct.
person.
Except the supervisor.
Okay.
So they would need to name a supervisor.
Okay.
But the single person owned business, they can be the general manager, director, and legal rep. So this next slide just summarizes really the key management team. I think it's important, if you're being hired by a company, to include in your contract that if you resign, that the company will take action to replace you from one of those legal registered positions. So the responsibility stops. And I did mention a minute ago, the legal rep can be the chair of the board, it can be the managing director or the general manager. But the legal person is the person who, if the authorities have any issue, that's the first person they go to. So it's the person's neck who's on the line. But I quite often get asked, what are the fiduciary duties of a director in China? And actually it's the same as they are in most countries.
Okay.
They have a responsibility to the stakeholders at large to run the business properly.
So it doesn't change that much
No.
compared to other places.
Correct. So I mentioned earlier about that you've looked at your costs. So the key with defining what your registered capital requirement will be is really how much funds you need until you become operational. So it's a matter of preparing a cash flow, taking into account, maybe being conservative in terms of the timing, and noting very importantly that you can increase your registered capital at any time if you need more. You can also decrease it if you've stated a higher figure, but you don't need that in the end. And there's no specific time limit for investment, and most companies will put 5 to 10 years in their business plan. But even if you get to the end of 5 years, when you put 5 years, you can apply for an extension for another 5 years. So it's actually very flexible now. The other thing, depending on what your investment amount is, we've got something called registered capital and total investment. So total investment, the difference between the two would be an investment loan. There are thin capitalization rules. So for instance, below $3 million US, you must have a minimum registered capital of 70% of that. But an example, in this situation, you could have just below 30% as an investment loan, which is registered, but you don't necessarily need to use it. It gives flexibility. It depends really whether it's worth doing it, depending on the size of your total investment. I mean, if you're only investing €100,000, for instance, then it's not really worth doing, because the bureaucracy of registering that 30,000 loan is
it's
not worth it.
also very costly.
Correct. It's not worth it. And the steps. So first is to apply for the name. So we talked earlier about register your trademark. The name, though, that's registered with the AIC is actually your Chinese name. So you may have a brand, global brand, ABC, but you will need a Chinese brand as well. And it's important to do to get a trademark agent to do a search to see if that brand is available and not being used by somebody else, so you're not going to conflict with somebody else, and to try and come up with a suitable Chinese name. And normally we say to companies, come up with at least 3 names, try to make them maybe ideally these days slightly longer, maybe not 2 characters but 3 characters or 4 characters, because it's more difficult to find a name that's used with shorter characters.
I actually did not mention that when you discussed IP, but actually for European SMEs coming to China, there is another European project, the IPR SME Help Desk, that also provides first line of advice on these issues. So it's also free of charge. So definitely go for it.
That's very, very good. Because I think that's one of the most critical things at the beginning, is to get find your brand and get it registered. Both English or whichever nationality, language, but also your Chinese name, Chinese brand. The name of the company actually will be sort of whatever it is in Chinese characters, plus what you do, plus your city. Because that often people say, well, can I put China? You can only put China if you have investment as a holding company. Otherwise, you have to put the city you're registered in. But most of the time, you'll only use your full name on banking, for instance, or FIEs, the official tax receipts. You will normally just use your main brand on a day-to-day basis. We'll then apply for the business license. We go to the Ministry of Commerce, MOFCOM. Once we get approval and we get the business license, we would then get the company seals. I'll talk about the CHOPS or seals in a minute. We would then apply for tax assessment. Tax assessment is, where are you as a VAT payer? Are you a small VAT payer, in which case you pay VAT on your sales and you pay VAT on your suppliers, or a general VAT payer where you need to meet revenue or demonstrate you're going to meet revenue in the first year of 5 million RMB, in which case you can become a general VAT payer, and general VAT payer would operate exactly the same as it does in Europe, where you can offset your input and your output VAT. We'll then set up a registered capital bank account, a RMB basic or current account with internet banking. We may need other accounts, so if the RMB basic account is with a foreign bank, for instance, that can't link with the tax bureau, we might need to set up a second account which can link to the tax bureau for tax payments. You can have a foreign currency account for trading money, moving cross-border, but you can't operate in foreign currency within China. And so it depends on whether that's worth it. And I put here, usually it takes 8 to 12 weeks depending on government efficiency, but as we spoke earlier, there is a directive to reduce that to 5 days. And certain areas of China already are much faster than other areas. Within that 8 to 12 weeks actually also includes collection of documentation as well.
Yes, I mean, I think that definitely government efficiency is a big factor in this process, but of course it's also up to the companies themselves to, again, do their homework and gather the necessary documents in a timely manner.
I would agree. And just maybe on point 5, I would take tax assessment, for instance. Generally, most of the country, the legal representative with passport doesn't need to come into the country. But some parts of China, and we're talking districts here, not even the greater area, one particular district in Shenzhen, for instance, that the tax officer needs to see the legal person with their passport. Ridiculous as that is.
Interesting.
So it does even come down to district level, but there is a directive to streamline, but the homework is important at the beginning. In terms of company seals or CHOPs, it is a requirement for doing business in China. It is unique. It is registered. The CHOPs are registered with the Public Security Bureau, so they're on file. They will be registered with the bank, so they're on file, and they are unique and they are non-transferable. You do have different CHOPs that you need to get. So company CHOP is you only have one, and it's very important to keep that in a safe place, ideally in a safe. A finance CHOP is used for banking, and it's useful to have a contracts CHOP, which is used on a more day-to-day basis for chopping of contracts. You can have signature seals or CHOPs, so example where the legal representative is based overseas, to have a CHOP that's kept with somebody trustworthy and in a safe in China.
Yes, I have heard a lot of horror stories about CHOPs here in China, so definitely be careful with that.
Yeah, we have a CHOP library in our office with a sign-in, sign-out for all different company CHOPs for all different clients. But the key is if you have enough internal controls and segregation of duties internally, then you can do that yourself. If you don't, have a trusted representative externally who can hold it for you. Mm-hmm. But it's a matter of, because the legal representative's CHOP with the company CHOP is very powerful.
Absolutely.
And can be used, example, to set up new bank accounts or set up subsidiaries or actually do almost anything.
Yes.
So you're set up, you've got your CHOPs, you've got your bank set up, you're operational, you've brought your investment in, and you want to hire somebody. The labour laws in China are quite robust and are not too indifferent from what you would expect to see in many European countries. Mm-hmm. You have specific requirements for an employment agreement that is a full employment agreement that does reference labour law and does have all the terms of employment. This is where the Americans sometimes get unstuck because they're quite used to giving letters of offer, and where a letter of offer in China is not sufficient. That's to agree the key terms. You need to follow that up with an employment agreement within 1 month of the individual joining the company, or you can be liable for double salary payment. Mm-hmm. Staff handbook and company policies is a way of protecting the company, by example having a fraud no policy, having a use of technology policy, creation of IP policy, etc., to protect the company. Tax planning and employment planning for individuals, foreign and locals, and social security management. There is a social security system here, social welfare system, that covers certain benefits for individuals, which is compulsory, though many companies may consider top-up insurance, for instance, for medical, because the social welfare net doesn't cover 100% of medical. Mm-hmm. Expats who work here need visas. Payroll calculations are done on a monthly basis. In the current individual income tax law, it's a rolling year-to-date basis as you do the calculation. And then if you are, let's say you've hired people and you're looking to downsize or close, if you lay off more than 20 people or 10% of the workforce, then you're theoretically meant to go through a process of applying for permission with the Labour Bureau. Mm-hmm. Though in practice, there are severance requirements in terms of payments, and so asking people to, in this situation for an SME, the practical solution is, if you resign, I'll pay you the severance and I'll give you a reference.
Right.
So it does come down.
That's the easy way.
That's the easier way, if that can be done. But it is important to make sure that you onboard people properly and then you offboard people properly. Mm-hmm. And lastly, there is a myth that once you're in China and operating in China and hopefully being successful in China, that it's not easy to pay funds out of China. The reality is actually it's very easy. It's just bureaucratic and it does take time.
Is it costly too?
Not so costly, it just takes time.
Okay.
So you have banking fees, of course, and the banks do take a large spread between the currency movements.
Right.
And the banks do have their own filing requirements in the State Administration of Foreign Exchange. If you're moving products back and forth, then the Customs Bureau is linked with SAFE, which is linked with the banks. So for products money payment, product-related money payments, it's actually very simple. Where it becomes more complicated is non-product related. So there is a requirement where you're doing a payment above $200,000, for instance, as one payment that you need to go and get clearance from the State Administration of Foreign Exchange. If it's above $50,000, then you would get pre-clearance for the Tax Bureau. If it's a longer term contract, we would normally recommend that you get pre-clearance at the beginning with the Tax Bureau at least. Mm-hmm. And then for future payments, it's already cleared. You've already had a tax assessment, and so it's just a matter of paying the taxes and going to the bank to make the payment. But for smaller amounts, as long as you have an invoice and you have a contract, you can go to the bank and make the payment first, and then get tax clearance and pay the taxes later. Dividends can be declared at any time as long as it's on retained profits, that they've been audited, and that you've paid your corporate income tax on those profits. I did put a note in the slide. There is a requirement that you have to hold back 10% of your retained profits for the year into reserves, up to the point where your reserves become 50% of your registered capital. Mm-hmm. And I'm not sure how long they'll keep this particular note going, actually, because it doesn't make any logical sense now that registered capital has no specific requirement.
Right.
But anyway, that's currently how it sits at the moment. So it is actually easy to move money out of the country. It just involves a little bit of planning and making sure that you have proper agreements in place. And there are some things that need to be pre-cleared, like royalty agreements, for instance. You pre-register those with the Ministry of Commerce. And then as soon as you've got that approval, because the tax on royalty is set by legislation, it's just a matter of going to the bank.
Okay.
So the bureaucracy part is paperwork and still filling in forms for cross-border payments.
Good to know that it's not as hard as it looks.
Yes, bureaucratic but possible. And it just involves a little bit of planning. So we always say to SMEs, and actually this is something an SME should do anyway, any company should do, is continually cash flow planning. Mm-hmm. So it's just a matter of factoring in your cross-border payments within your cash flow planning.
Right. Yep. Okay, well, thank you very much, Russell, for this very comprehensive presentation.
Thank you.
We have talked about risks, we have talked about different areas and different issues to look at when setting up a company, including IP, management, investment, the setup process, HR issues, tax issues. So I believe that our audience will have gotten quite the big picture. So again, thank you very much.
Thank you very much for inviting me to speak.